All right, in this final video for Chapter 4, we're going to wrap up our discussion of adjustments for AGI by looking at several additional adjustments that appear towards the end of the chapter. This includes deductions related to tip income, adjustments connected to overtime pay, and deductions related to auto loan interest. Now, some of these rules are relatively new and they're still evolving, so the important thing for our purposes today is to understand how these types of deductions fit into the overall tax framework rather than memorizing every single detail. The key takeaway is that these deductions, like the others that we've discussed in this chapter, they reduce income before adjusted gross income is calculated. So let's start with tip income. Many workers in industries like restaurants, hospitality, and personal services receive a portion of their compensation in the form of tips. These tips are considered taxable income, which means that they must be reported and included as part of the taxpayer's gross income. However, under certain provisions, taxpayers who receive tip income may qualify for deductions related to that income. One of the things students often ask about here involves the $25,000 limit that appears in these slides. For married couples filing jointly, that $25,000 limit applies to the couple as a whole, not separately to each spouse. So if a married couple files a joint tax return, the total deduction related to tip income cannot exceed $25,000 combined. Another question students often ask is whether both spouses must earn tips in order to qualify, and the answer here is no. Both, and this is unique. So when we talked about the educator's expense, both of them had to be educators. Here, both spouses do not need to receive tip income. If one spouse earns tips and the couple files a joint return, the deduction may still apply up to the overall limit of $25,000. The key requirement is that the tips must be properly reported as income. So if they're never reported as income, then there's no deduction to be taken. And this is an important point because historically there have been challenges with tip reporting in some industries. From a tax perspective, the IRS expects tips to be reported just like any other form of compensation. So when we talk about deductions related to tip income, we're talking about reported taxable income, not those cash tips that maybe went unreported. This section of the chapter highlights how the tax law sometimes includes adjustments that apply to very specific categories of workers or income types. Now let's talk about overtime pay adjustments. Overtime compensation occurs when employees work more than the standard number of hours in a work week and receive additional pay for those extra hours. Under certain provisions discussed in the chapter, adjustments may apply to portions of overtime pay. The amount allowed as a deduction for any tax year is limited to $12,500 for single taxpayers or $25,000 for married filing joint. Now that deduction begins to phase out when the taxpayer's modified adjusted gross income exceeds $150,000 for single or $300,000 for married filing jointly. And finally, let's cover the auto loan interest deduction. Interest on loans is something we encounter for many different contexts within the tax system. For example, earlier in the chapter, we talked about student loan interest, which may be deductible up to certain limits. In a similar way, interest on certain auto loans may qualify for deductions under specific circumstances. When we talk about auto loan interest deductions, the key factors usually involve the type of the loan, the purpose of the loan, and whether the taxpayer meets the eligibility requirements set out in the tax law. For the auto loan interest, the deduction is up to $10,000 in interest paid during the year. However, certain restrictions do apply. So for example, the vehicle must be new, it must be for personal use, and its final assembly must have been in the United States. And like others, the deduction phases out for individuals with modified AGI exceeding 100,000, and for joint filers, it starts phasing out for AGI over 200,000. Now, before we wrap up Chapter 4, let's revisit the tax formula one last time. We start with gross income, which includes wages, interest, dividends, business income, and other forms of taxable income. And from gross income, we subtract adjustments for AGI, which is what we studied throughout this chapter. That gives us adjusted gross income, or AGI. Once we have AGI, we then move on to other deductions, such as the standard deduction, or are we taking itemized deductions? After those deductions are applied, we arrive at taxable income, which is the amount that is actually subject to the tax rates. So that brings us to the close of Chapter 4. If you have any questions, please don't hesitate to reach out. You know how to reach me. Otherwise, I'll see you in the next video. Thank you.